Good afternoon, everyone, and welcome to the McGuire-Woods webinar on tax reform and the impact on employee benefits for tax-exempt organizations. My name is Taylor French, and I'm here with Michelle McKinnon, Allie Tanner, and Brad Reidelhoover, and we are all members of the McGuire-Woods nonprofit and tax-exempt organization team. Before we jump into the presentation, just a few words about our industry team. We cover all types of nonprofits, ranging from tax-exempt and charitable organizations, universities, both public and private, other educational institutions, hospitals, healthcare organizations, trade associations, churches, political organizations, foundations of all sizes and shapes, whether that be family, corporate, or community foundations. We have a wonderful team that really works across a multidisciplinary set of practices. Allie and I come from a primarily compensation and employee benefits practice. Michelle and Brad come from a corporate governance and estate planning practice. And I think what you're going to hear today when we walk through this new excise tax and its implications on tax-exempt organizations is that this is really a tax that has many different facets, and in order to really understand the rule and really to think about and strategically plan as to how to address the rule within your organization, it really does take a sort of team approach of folks coming at this with different specialties. So with that, by way of introduction, I'll quickly go through an overview of this new excise tax codified under Code Section 4960. This was part of tax reform that was passed at the end of 2017. And the first item that I really want to flag for everyone on this call is the fact that we're really talking about it's an excise tax that is comprised of two different parts. The first part is a 21% excise tax on excess remuneration, and frankly, that's the part of this tax that has gotten a lot of the headlines because it is an excise tax applied essentially on compensation paid to certain covered individuals that exceeds $1 million a year. And so the $1 million threshold is an easy headline and relatively straightforward to understand at a very basic level. Allie's going to walk through a lot of the details that actually and nuance behind that portion of the tax. But then the second part of the tax is a tax on excess parachute payments. And this is where, based off of a lot of conversations that we've been having with clients, there's a whole lot less certainty around what is an excess parachute payment and how do I figure out if I have an excess parachute payment. And from our conversations that we've been having, this is an area where there could be some surprises for folks. These are rules that are largely both the excess remuneration tax and excess parachute tax have in some ways their origins from taxes applied to for-profit organizations, and as a result of that, we have a lot of experience and history that we can sort of bring to bear in terms of helping people understand these taxes and manage them. Part of the reason why we're having this webinar right now is because, as you can see from the effective date, this tax is now live. So for a lot of tax-exempt orgs that we work with, especially in the college and university space who might have a non-calendar year fiscal year, even so, this tax is effective and something that we should be focusing on. The other reason why we're having this webinar is that new IRS guidance has come out at the beginning of this year. Before now, we just had a statute with not a lot to go on, and so it was sort of a wait and see. But that time is frankly over. The folks that have dialed into this call, and I saw from our invite list, is, as we all know, generally all tax-exempt organizations are going to be subject to this tax. Though, as we're going to talk about later in the presentation, there are some opportunities for governmental entities to be exempt. Finally, so as a brief sketch of an overview of the presentation, we're going to go through the rule, and we're going to help understand, hopefully help you all understand sort of the nuances and some of the technical aspects of the rule. And then we're going to reserve some time towards the end to a more practical aspect of the rule as to what should you be doing now. The tax is effective. We're going to have to live with this rule, and what strategies can we put in place to minimize our tax obligations, and what should we be thinking about from a corporate governance perspective in order to operate within this framework. And so with that, I'm going to turn it over to my colleague, Allie Tanner, to start in on the excess remuneration tax.
Great. Thanks, Taylor. So the first thing we're going to talk about is the excess remuneration tax that Taylor mentioned. As he said, it's a 2017, it was imposed under the 2017 Tax Act, and it's a 21% tax on most tax-exempt organizations on remuneration in excess of $1 million for covered employees. Now, I know I said a lot in there, and what I'll focus on is what this definition of remuneration is. A little bit later in the presentation, Michelle will talk about who this applies to from an organization standpoint and who this applies to from an employee standpoint. There's a lot of information in these slides, but obviously we only have an hour today, so I'll sort of try and hit the high points, but if there's any questions, please feel free to reach out to us. As far as what is included as remuneration, the general rule is that you include anything that is considered wages, which is defined in Code Section 3401, and in other words, that's typically compensation that's subject to federal income tax withholding. The key thing to remember when you're looking at wages is that this is not the same as W-2 compensation. So it's not as simple as just saying what went on the W-2, that's what we're going to put as remuneration. It's a little more nuanced than that. One example is that if there's taxable fringe benefits, those are included in the W-2 income, but those are not subject to the federal income tax withholding under 3401. So that's one example of a distinction between remuneration under this tax and W-2 wages. There's also some specific sort of categories of things that are excluded. There's a lot of exceptions in 3401, so you definitely want to pay attention to those. But there's also some general exceptions that deal with typically retirement plans, director pay, and then one we'll focus on a little bit more later in the presentation, which is medical and veterinary pay. So not only do you need to know what categories of remuneration are included, but also what time periods are you looking at to determine what remuneration is included. The general principle you want to remember here is the inclusion rule, which essentially says that, as the name suggests, remuneration is counted for the year it is included in the employee's income. This is a similar principles to Code Section 457. So, for example, non-competes may extend the substantial risk of forfeiture, and you would apply the same rolling risk of forfeiture or delays rules that apply under 457. Since this is a new rule, there are some considerations as far as pre-effective date remuneration. The way that the IRS has approached this is to say anything that was vested but not actually or constructively paid as of the close of the employer's taxable year preceding the first taxable year that the tax is effective is not subject to the excise tax. So essentially what that boils down to is that if you are a calendar year employer, the present value of vested remuneration as of December 31st, 2017 is not included. And if you are a non-calendar year employer, the present value as of the close of the taxable year that includes December 31st, 2017 is not included. So for a lot of universities or schools, their tax year is typically matches the academic year, so it would be from July 1st to June 30th. So for those folks, that tax year that is vested as of December 31st, 2018, June 30th, 2018, would not be included. On a going forward basis, your covered employees, as Michelle will discuss, you could have new covered employees over time. So you also have to look at when do you start counting remuneration for someone that has become a covered employee. This one's a little bit more complicated, but essentially you look at it's vested but not actually paid remuneration as of the end of the calendar year preceding the calendar year ending with or within the employer's taxable year treated as paid for employer's preceding taxable year. Now that's sort of a formulaic approach, but it's easiest to look at an example which says that if an employee becomes covered for the taxable year ending June 30th, 2020, then the calendar year that ends within that year is December 31st, 2021. So you would go back a year, and any vested remuneration as of December 31st, 2020 would be what is not considered subject to this tax. So once you've figured out sort of what remuneration is included, both from a categorical standpoint and from a timing standpoint, the next question would be how do you determine the amount of the remuneration? Here the general rule is that the amount treated as paid is the present value of future payments measured as of the vesting date. You're going to use Code Section 457 rules and assumptions if you want to fall into the safe harbor. And one of the specific categories you'll probably need to deal with is earnings. Now, if you have an account balance plan, earnings are measured as of the end of the calendar year, and they're treated as paid at the end of that year in which they accrue. So you look at December 31st, see what earnings were added, and then you would, if they were accrued that year, they're treated as paid that year. For non-account balance plans, you include that amount in the present value of the benefit as of the end of the calendar year. And when you're looking at these amounts, sometimes you may have earnings and sometimes you may have losses. So you can aggregate these amounts, but only on a plan type basis. So this means that you can aggregate these amounts for account balance plans, and you can aggregate these amounts for non-account balance plans. But you cannot cross over between these two categories. The losses would be used within that category of plan to reduce net earnings. And if the losses do exceed earnings, there is the opportunity to carry forward some of these losses as long as you stay within that same plan category. Now, I know we talked a little bit earlier about categories, and one of them we said I would go into a little bit more detail on is the exception for medical and veterinary services. This will typically apply in the case of a hospital or a university hospital setting where someone may be both a doctor and a professor, for example. So any remuneration that they receive for their medical or veterinary services are excluded from the definition of remuneration. When determining what is considered medical services, you look at Code Section 213, which is referenced here in the slides, which generally includes diagnosis, cure, mitigation, treatment or prevention of disease, those types of things, and those you do not include here. Now, as I mentioned, you may have someone who is both a doctor and a professor, or a doctor and deals with administrative roles and that sort of a thing. Those administrative roles or teaching roles do need to be included when you're looking at remuneration. So how do you divvy up between these two roles? It's really a good faith allocation that is what the IRS requires. For some folks that already have employment agreements in place, you can look at records of if they do time entries or that sort of a thing, different peer reviews of compensation. For people that you have not yet hired, or if you want to amend folks' employment agreements, one thing to do is to provide for this allocation within the employment agreement itself. Generally, that allocation will be respected unless there's facts that show it's specifically designed to avoid this tax. To fall under this exception, keep in mind that the individual, meaning the employee, must be a licensed medical or veterinary caregiver under applicable law. So you would look at state and local law to make that determination. You may end up in a situation where you say, okay, for us as an employer, we pay this person X, but there's also what we call related organizations, and they also get money or remuneration from the related organizations. So when do we have to include that? Michelle will go into more detail on what those related organizations are, but it's generally organizations that are controlled by or that support a tax-exempt organization that's covered by this rule. In this situation, you would be able to allocate between both the tax-exempt organization and the related organization in proportion to the remuneration that's paid by each entity versus the total remuneration paid to the covered employee. The rules don't address it, but one possible situation may be to have a reimbursement where the tax-exempt organization reimburses the related organization for the remuneration they pay, or vice versa, and that could affect the proportion or the allocation of this tax. The rules do say that if someone is employed by both a tax-exempt organization and its related organization, such that there's remuneration paid by both entities, that there cannot be a double tax. So you pay the greater of the tax if you're owed that you would be owed as a tax-exempt org or as a related org. So if I'm entity A and I employ someone both as a tax-exempt org and I employ someone as a related organization of a separate tax-exempt org, I'm only going to have to pay tax on that covered employee once. And that's just from an entity A perspective. If an employer ceases to become a related employer during a calendar year, that does cut off this remuneration tax such that only remuneration paid while the entities are related counts. So I know I went through that quickly, but in the interest of time, I will turn it over to Taylor, who's going to talk about the excess parachute payment tax.
Great. Thanks so much, Allie. And as Allie mentioned, there are a lot of material, a lot of information on these slides. We are going to be monitoring the Q&A tab here to the extent we can. So if you want to submit questions that way, please feel free. To the extent we can't get through, we can't get to all your questions or can't fit it into the presentation, we'll reach out directly after the presentation is over. This next part of the tax is the excess parachute payment tax. And as I mentioned earlier, this is a tax that frankly can be a little bit sneaky for folks because it's not as easy to grasp as a tax on compensation over $1 million a year. And what the tax is this is borrowed really very closely from the golden parachute excise taxes that apply to for-profit companies in the context of change of control transactions, with some key differences in the tax-exempt space. And it's a 21% excise tax on excess parachute payments to the extent they exceed an individual's base amount. So there's a lot there to unpack in that very top portion of the slide. But the key aspect is when is this tax going to be triggered? And it only applies to the extent that the total amount of parachute payments, and we're going to get into what parachute payments are in a moment, but if the total amount of parachute payments equals or exceeds 3 times the covered employee's base amount, only at that point is the tax triggered. If the parachute payments are 2.5 times base amount, no tax. If it's 3.1 times or 3 times or greater, then this tax gets triggered. And this is what the sort of interesting part about this tax is that the tax is triggered not on the excess over 3 times. Once you hit 3 times base amount, the tax applies to everything over 1 times base amount. It's a quirky sort of formulation, but one that we've seen for years in the for-profit world. Let's talk a little bit about what base amount is, because it's obviously a key point here. And essentially, it is the 5-year average aggregate compensation of a covered employee. And those 5 years are the look back for the 5 years prior to the year in which the parachute payments are made. To the extent that someone may not have been working for the full 5-year period, there is an annualization concept that applies. Now, not all compensation can be annualized. The primary type that you would annualize would be someone's base salary, but the idea is to annualize that compensation to get a truer base amount for those folks. When you're calculating someone's base amount, because we're looking at gross income, certain amounts that are excluded from gross income, like fringe benefits, employer-provided health care benefits, those do not factor into someone's base amount. On the other hand, compensation that is included due to what's called a Code Section 83B election, and that is a special tax election that can be made on grants of restricted property, to include those amounts in income prior to the date on which the restricted property vests. If those types of elections have been made, that would be included in gross income and increase someone's base amount. The payments that are covered by this excess parachute payment tax are what are known as payments in the nature of compensation, and they have to be contingent upon a separation. So whereas the for-profit rules focused on change of control, what we're talking about here are compensatory payments paid to someone upon their separation. The 4960 regulations pull in Code Section 409A, which is a federal deferred compensation tax set of tax rules that has a very specific definition as to what constitutes a separation from service. Generally speaking, an 80% reduction in services, there is a separation. After 50 to 80%, it's a facts and circumstances determination. This is important because to consider when we're talking about possibly a senior administrator who may be separating but retiring, but consulting for some period thereafter. Or potentially faculty members or a college president who may be stepping down as the college president but may retreat to the faculty for some period of time. So you need to really analyze as to whether or not a separation has actually occurred. And then for this tax to apply, the regulations state that the separation must be involuntary. So what does involuntary mean? It's generally considered a unilateral action by the employer. A failure to renew contracts can qualify as involuntary. Good reason, or what's sometimes known as a constructive discharge standards, may be acceptable here. And then the types of payments that we think about that could be considered subject to this tax, we've got the list here, but some of them that I do want to just flag is obviously your typical wages and salary, bonuses. The one that can come up often, because this rule, both the excess remuneration tax rule and the excess parachute payment tax rule, were in some ways aimed at college and university coaches. So buyouts of coaches' contracts can certainly trigger these rules, as can payments for non-competes. So those items may be covered by this tax rule. We've got the list of exclusions here. from these rules. Attorney fees and costs, these are really with, in terms of settlements that we're talking about here, and interest if there's a, contested payments. To the extent that payments have already vested, well, those might be subject to the excess remuneration tax rules, but not necessarily the excess parachute payment tax rules. I mentioned consulting fees earlier and consulting services and whether or not that would have an impact as to there's been a separation for purposes of these rules. To the extent that you're providing a covered employee with consulting fees for services post termination of status as an employee, well, those consulting fees actually can be excluded for purposes of determining the excess parachute payment taxes. Our next slide has a discussion of some special valuation principles that we just wanted to flag for folks. And here, again, these regulations borrowed heavily from the Code Section 280G principles. We're not going to necessarily go through all of these in detail, but the real big takeaway from this is that the value of a payment may not be as simple as, well, how much is the aggregate amount that we're going to pay someone? In the context of payments that are entitled, that someone may earn based off of continued service that get accelerated in connection with a qualifying separation, well, there's this special valuation principle. And in effect, what happens is the value of those accelerated payments subject only to continued service is actually less than, for purposes of this tax, less than what the total amount of the payment might be. On the other hand, if you're accelerating payments that are subject to performance conditions, as in the top right, then the entire value of that payment would be included in the excise tax. For employers who may have non-qualified deferred compensation plans for some of their employees, there is a acceleration value associated with previously vested amounts. If it's a non-vested amount, then that value may be higher. To the extent that you might make additional contributions of non-qualified deferred comp, those also would be included as excess parachute payments. And with that, I will turn it over to Michelle and Brad to help lead us through the ATEOs and related organizations.
Okay, we're going to start with the definition of applicable tax-exempt organizations and related organizations. And this is where, obviously one of the key issues here is determining whether you're even subject to this tax. So you need to know who an applicable tax-exempt organization is, but the rules are also written very broadly to pull in a number of related organizations of all sorts. So we're going to work through that. There are also some technical glitches that were in the statute as drafted, so that what Congress thought they did not actually do, and that's continued to create some issues and some concerns, and we don't exactly know where that's going to end up. It may depend on technical corrections, so we'll talk about that as well. But an applicable tax-exempt organization is any organization that is exempt from tax under Code Section 501A. That's a really broad provision because the ones that are exempt from tax under 501A are all the various 501C organizations. That would include charities under 501C3, social welfare organizations under C4, trade associations under C6. But there are about 20-some organizations listed under 501C. And those are the organizations that are exempt under 501A. So it's a lot of organizations picked up under this particular tax, and that provision is much broader than, for example, the excess benefit transaction tax, which does not pick up every type of 501C organization. So it's important to understand that the scope of this tax is fairly broad. It also picks up farmers' cooperatives under Code Section 521B1. An organization, it's usually governmental, that has its income excluded from taxation under the provisions of Internal Revenue Code Section 115.1, or a political organization under Code Section 527E1, and that's typically PACs. What's not picked up is certain types of governmental entities that are not exempt under 501c3 and that do not have their income excluded under 115.1. And that is where the technical glitch is, because Congress thought they had included, for example, colleges and universities who are public universities exempt from tax because of their instrumentalities or integral parts of the government, political subdivisions, whatever one it may be. But they did, the way the statute was written, technically they did not get picked up. And we'll talk about the ramifications of that in a few minutes. So they also, though, pick up all the related organizations to all the applicable tax-exempt organizations, and this is where some of the complexity comes in. Fortunately, the rules do follow the definitions of a related organization that are used for purposes of reporting on the Form 990 filed by the exempt organization. So if you're completing that form accurately, you ought to know who your related organizations are. But it does require really delving into the types of entities, the governance, and a variety of different factors, such as tax classification even, to tell who's a related party. It's important to note that a related party can be a for-profit, it can be a governmental entity, even one that would not be subject to tax otherwise. But you're looking at whether or not an employee of the applicable tax-exempt organization might also be being paid by one of these related organizations. So what's a related organization? It's one that's controlled or controls the applicable tax-exempt organization. It is one that's controlled by one or more persons who control the applicable tax-exempt organization. If the related organization is the supported organization of the applicable tax-exempt organization, it is covered. And that's a technical term. I mean, that is a type of tax classification under the Internal Revenue Code. So if you have an organization that is classified as a supporting organization under 509A3, even if it's not controlled by the one way or the other, you're not going to be subject to these rules. But if you're a supported organization, you're subject. If you're a publicly supported organization without control, you're not subject to the rules. So tax classification issues can be important as we go through this. So supporting organization relationship within the meaning of the tax classification rules is important. Lastly, if the applicable tax-exempt organization is a Voluntary Employees Benefit Association, or a VEBA, and any entity that establishes, maintains, or makes contributions to that VEBA is a related organization. So one way, as we just mentioned, that related organizations get pulled in is through control. So a key aspect of all of this is figuring out how you determine whether an entity is controlled by the applicable tax-exempt organization or vice versa. In the case of stock corporations, and this would be, for example, a taxable subsidiary of the nonprofit, but it can also be the reverse, where the stock corporation controls the subsidiary. You look at ownership by voter value of more than 50% of the stock of the corporation. In the case of trusts, it's more than 50% of the beneficial interest in the trust, and that's usually done on actuarial values of the respective interests in the parties. And it could pick up, for example, wholly charitable trusts. It could pick up charitable remainder trust, charitable lead trust, although I think it would be highly unusual to actually have employment or compensation being paid out of any of those trusts. And I couldn't really come up in my head with any type of trust that might get picked up, although some nonprofits are created as trusts. Partnerships, you look at ownership of more than 50% of the profits interest or capital interest in the partnership. Now, ownership looks to determine constructive ownership. You use the for-profit rules under Code Section 318, and those are pretty well established. What's probably more likely to be the case with nonprofits is to have non-stock or not-for-profit organizations where there's no ownership involved in the mix of related organizations. And so there you need to understand how they're going to apply these rules in that context. And they look to see whether more than 50% of the directors or trustees of the applicable tax-exempt organization or the other non-stock organization are trustees, directors, agents, or employees of the other entity, and that can be direct or indirect. And then whether or not 50% of the directors or trustees of the non-stock organization, potentially related organization, is a representative of or directly or indirectly controlled by the applicable tax-exempt organization. And control is a broad term. It can be the right to appoint directors. It can also be the power to remove directors or officers. So you need to really focus on the governance of the organizations to determine whether or not they can fall within the definition of a related organization under the control rules. You might get there faster, might be able to make the determination faster if you are actually dealing with a supporting organization within the meaning of the tax rules. So one important thing to point out, if you're doing any planning around these control rules and trying to eliminate control to minimize the application of the tax, you need to be very careful if you're dealing with supporting organizations, because the governance structure drives the tax classification in almost all of those situations. So if you start changing the governance, you may lose the public charity tax classification as a supporting organization. That might be fine, but you need to know you're doing it, and you need to figure out what other classification might work. For example, after the 2006 Act, and as these rules have continued to impact supporting organizations, and this would be another example, we've seen organizations shift from supporting organizations to publicly supported organizations where they're able to meet the public support test. And that would certainly be an analysis that you would want to go through if you were going to try to eliminate control. The last thing I want to talk about are governmental entities. And again, this is where Congress made a mistake, and so they didn't pick up everybody they thought they were picking up. So we do know what the rules are, and the IRS is abiding by the terms of the actual statute, even though there was some belief they might try to pull in what Congress accidentally didn't pull in. They did not in the guidance issued to date. What we still don't know is whether there will be a technical correction bill that will pull in all governmental entities. But right now, those organizations that exclude their income because they are Code Section 115(1) government entities are applicable tax-exempt organizations. If you have a governmental entity that does not have 501c3 classification and is not excluding income under 115(1), it is not an applicable tax-exempt organization. This can pick up state colleges and universities, public hospitals. There are a lot of these. But what's happened with some colleges and universities, and possibly others, is that they've actually, in addition to being exempt from tax because they're governmental entities, they've gone and actually applied for 501c3 status. So they hold a 501c3 letter. The IRS has made it very clear that those entities that have the 501c3 letter, even though they would otherwise be excluded, are subject to these rules and are applicable tax-exempt organizations. They've also said that you can revoke that status. You can give up your 501c3 status, and then go forward, you're not an applicable tax-exempt organization. I think before you want to go through all of those types of steps, you need to think about whether that's the right thing to do. For example, many organizations get the 501c3 letter because they raise money, and the deduction rules are better for a gift to a 501c3 than they are for a gift to an instrumentality or some type of entity that's not the state, but that is part of the state, and the percentage limitations are different. There might be other reasons for having obtained the 501c3 status, so you want to think about those reasons before you go and revoke or give up your 501c3 status, particularly given that we still think Congress intended to cover these entities The examples in the legislative history make it clear they thought they were doing it and they didn't. And the key here is that, just to put this in the context of what it means in the real world, if you are a public university hiring a basketball coach, you can pay them 5, 10, whatever millions of dollars you want, and you're not subject to the tax unless you have that 501c3 letter. On the other hand, if you're a private university that's exempt under 501c3, you can hire that same coach for the same pay, but your college or university is going to have to pay the tax. So it has real-world ramifications, but we just don't know at this point how that's going to shake out unless and until we have technical corrections.
So we've talked now about which organizations would be classified as the ATEOs or the related orgs. Now we need to think about, well, what employees are going to get captured in this rule and be subject the organization to this excise tax. And so looking at this, the basic rule talks about is one of the 5 highest compensated employees of the organization for the taxable year, or that was a covered employee for any of them beginning after December 31st, 2016. And this is this once a covered employee, always a covered employee kind of concept, so the numbers can get larger than you think. But when we think about who are the 5 highest paid, you cannot look just at your one organization. You must also bring in the pay that is given or remuneration made by the related organizations. So you're going to look at a calendar year. Now there is some exceptions for medical and veterinary that they talked about earlier, but you're going to combine the pay for both organizations or multiple organizations to determine who's the 5 highest paid for that ATEO or the related organization. And when you're looking at this, there is a small limited services exception down in the bottom box, and that deals with if you are the organization that pays less than 10% of the employee's remuneration, it's not going to be considered one of your 5 ATOs. It may be still would be one of the covered employees of the other that paid the 90+%. It won't be one of yours, but the pay is combined or considered, both pays considered to determine top 5 status. So when you're looking at this, you want to think through and find out, all right, well, who are my related organizations first, and then what compensation are they paying so that you can make the correct calculation. And then once you figure this out, we're going to have to think about, all right, what else are we going to deal with? Is there any other special situations, or how are we going to report and pay the tax? And so for those organizations that are on a calendar year basis, the time is coming. May 15th is around the corner, and that's when these taxes are due, and that's when you have to report the remuneration. Now, the first question is, where do you report it? Well, the IRS amended Form 4720, or updated it for 2018 tax year, to create a new section called Schedule N, and it's on page 9 of the Form 4720. The form's getting a little long these days, but Schedule N, and you report the name of the covered employee, how much excess remuneration was paid, or how much excess parachute payment was made, and you multiply that by 21% to come up with your tax. There's no requirement to make estimated payments, and there's no requirement. You can get an extension to file the return, so if you're not ready to file by May 15th for calendar year taxpayers, you can get an extension, but there is not an extension to pay, similar with other taxes. So come May 15th, if you are subject to this rule, you need to make your payments with your extension form 8868 or get your 4720 filed now. And you must make a separate form 4720 for each ATO, ATEO, or related organization. And, for some organizations, they may have never had to fill out a form 4720, but this is something that is now going to be triggered. All right, so thinking about what are we going to do now? We've identified who are entities that are covered by this rule, whether it's an ATEO or a related organization. We've talked about who the covered employees actually are that are going to be subject and how we're going to calculate and pay the tax. So thinking about what is it we need to focus on to do now. So as we said, when you're thinking about your structure and who you support, or if you're supported, getting the information together and accumulating what type of control you have, do you fall into these rules, what compensations are already being in play for other organizations, and just kind of getting a sense of what's the order of things and where do you stand and what have you committed to going forward to think about for planning. For the governmental units, we just mentioned that maybe you want to think about this 501c3 revocation of your determination letter, but maybe not. We don't know what's going to happen with the changes in the law. If you have multiple entities and you're going to have pay being spread across multiple entities, is there a reason or a room to kind of consolidate entities, merge, combine, or is there a reason to separate entities because of planning opportunities? So there's a lot of questions that we have, and it's only going to come into play until you kind of get a sense of where things stand and how you're governed.
Well, thanks, Brad. I think the other thing that you're going to want to get your arms around, and it's really sort of starting right now, as Brad mentioned, especially if you're on a calendar year, your taxes are coming due. But obviously, we want to start the process of figuring out, okay, well, who are our covered employees? And again, that's going to require now, for this initial year, it's going to require a look back to some historical compensation received by those employees. And as mentioned earlier, it's not just compensation of an applicable tax-exempt org, it's also related from a related organization. Well, to the extent that you're going to, now we need to interface, and you're likely already interfacing with the related organizations, but based off of our experiences working with other companies, is building those lines of communication with the right people at each organization to make sure we're getting complete and accurate lists of all compensation paid to an employee, so that way we can determine our top 5. The other processes that we imagine would be helpful to build into the most likely probably an HR function within an organization, but possibly legal function as well, is the maintaining of accurate lists to make sure that, well, just because someone who could have been a covered employee 1 year and then fell off of that list as a covered employee, and all of a sudden now they go ahead and their employment is terminated involuntarily, well, gosh, that person might be subject to the excess parachute payment tax. And so how are you going to ensure, and what processes are you going to put in place that any time there is a termination of employment, there is a cross-check to make sure, well, wait a second, is this person a covered employee? And that list has got to be a cumulative list. The other thing that I think is really helpful here is to the extent it already hasn't occurred, and there probably have been some preliminary conversations about this excise tax that went on right after tax reform, but to the extent that there really hasn't been a more fulsome discussion with board members and compensation committee members about the fact that, hey, this tax is now here, it's live, and we're living with it. And by the way, here we used to only have a statute, but now IRS has been good enough to provide us with, essentially 92 pages worth of meat on the bone, so to speak, that actually helps us interpret and implement this statute. Here's what this stuff really means. And as we've been talking about for really the last 50 minutes, there's a lot of nuance and detail in here. The other group of people that I think is helpful to frankly to reach out to are the covered employees. Let's not forget about them, because there may be, while the tax is very clear that it applies to the tax-exempt organization or the related organization, as a result of someone being, all of a sudden a covered employee for purposes of the tax, well, their compensation, may be subject to a little more scrutiny or it may be elevated in terms of who are the folks looking at their compensation, and the fact that we're going to have to get compensation information from possibly multiple sources, a tax-exempt org and a related organization. So I think it's a good process to get communication out there early to everyone who could be impacted by this rule.
Yeah, and so once you've got your covered employees, once you've sort of started that communication strategy, you also have to go through and really calculate this tax, as Brad mentioned earlier. So you need to look at the compensation levels for these folks, keeping in mind that it's Code Section 3401 wages, which is not the same as, your just W-2 comp, and making sure you really focus on those exclusions that are available there, and use the right pay codes if you're using pay codes, or identify the right amounts. And one of those exclusions we talked about and focused on a little bit is the medical and veterinary services. So make sure that you have a strategy for dealing with an allocation there, whether it's looking at the peer compensation or whether it's trying to document a more formal agreement of how much time is going to be spent on those excluded services versus, teaching or administrative services that would be, the remuneration would be included for.
Yeah, and Allie, I think that's a really good point that you make, and to the extent that, and frankly, prior to this tax, most employment agreements with, let's say, a doctor who served as a professor or an administrative role as well, there wasn't necessarily a real reason to provide that type of an allocation. But based off of our readings of the Notice 2019-09, I wouldn't go so far as to say a presumption, but there does seem to be some sense of deference to the notion of, well, look, if we're going to go through the process of spelling out an allocation in a employment agreement, then absent that being patently just designed to avoid the tax, then that's likely to be respected. And I think there, frankly, you probably want to have the backup, right, in order to provide, so that you're talking about two steps. One is amending people's employment agreements. Two, but in order to really do that, well, how are you going to determine the allocation? And I think you want to have the backup there that would support that allocation if it ever were to be challenged. Sorry, Allie. I know
great point. And then, there are other exclusions, so you can keep in mind, with those in mind, other strategies you may use to minimize the tax obligation. Some examples of that may be utilizing deferred compensation more often, since this isn't included until vesting, or focusing on those items that are excluded from 3401, and seeing if there's a way to increase those while decreasing the 3401 to sort of keep the same level of compensation, but have a lower potential tax liability. And along with figuring out the exact remuneration, you want to make sure that you figure out who is in charge of what. So you factor in the related organizations and the ATEOs that Michelle talked about earlier, and know who would be responsible for the tax between those various entities.
Yeah, flipping over to the excess parachute payment tax, here's where I think where there really needs to be some work done sooner rather than later, because I do think that there are some real opportunities here to minimize tax obligations associated with this. But the hard thing is with the excess parachute payment tax is that it's such an individualized threshold in that 3 times base amount, and that individualized threshold is going to change every year as someone's compensation maybe goes up, maybe goes down, maybe stays the same, but it's a more complicated set calculation and an ever-evolving threshold that we need to keep track of with respect to a covered employee. And it's one of those things where it can really, if you're not watching it, it can jump up and bite you come time of an executive's termination, because a classic example might be, well, we've got a person, we've never paid them over $1 million a year, so we've never really worried about them while they've been working for us with respect to the excess remuneration tax. But along the way, we haven't paid them that much because we have promised them deferred compensation under a 457F arrangement. Well, we can't, which is essentially we can't pay you now, but we're going to pay you later. Oh, and maybe if we're a 501c3 organization, we've also socked away some money under a 457B plan. Again, those for 501c3 organizations only available to a select group of management or highly compensated employees, not broad-based plans like in the governmental space. So you could have an executive or an employee who's built up a large deferred compensation account balance that all of a sudden that balance becomes due upon their separation, and while they've never triggered the tax before, because the balance between current comp and deferred comp is such that their current comp has been low, well, now their deferred comp is really high, and we've hit 3 times their base amount, and we owe a big tax associated with that. So what we want to do here is, I think the prudent thing to do is to, one, get your arms around, okay, well, where is everybody's threshold, and where are their potential excess parachute payments now, and what things can we do that might be able to minimize or avoid this tax altogether. Some basic strategies would be doing things to increase someone's base amount. That could be just paying them more money. That could also be taking amounts that are currently deferred and accelerating the vesting of those amounts. That has the double effect of actually increasing someone's base amount while decreasing what could be considered a parachute payment. There also are the ability to, as Ali mentioned, sort of allocating the tax burden between ATOs and related organizations, such to the extent that while perhaps the supporting organization would fund the tax burden. We're running close on time, so let me turn it right back over to Michelle and Brad for a moment.
Yeah, and I want to address, there was a question that came in about what would happen if an individual is paid both by an ATO and a tax-exempt org or governmental entity that's not subject to the rules, and would the ATO pay their portion and the governmental entity not? And actually, that's not the way they work, and I want to make it clear that even if the applicable tax-exempt organization is not subject to the tax, a related party can be, even if it's a for-profit or a governmental entity, and that's if they are paying an employee of the applicable tax-exempt organization. So I think it's important to note that even though governmental entities aren't applicable tax-exempt organizations, they can get pulled into paying taxes under the related organization rules. And in fact, the IRS has noted there's a big issue or some controversy around this related to, for example, a corporate foundation that does not pay anything to the officers of the foundation might have, though, highly paid officers of the for-profit entity that created the foundation on that board. Because they are treated as covered employees, the concern is that the for-profit is now subject to this tax because it's paying its officers. And the IRS has not yet figured out what they're going to do about that. And they realize there's an issue, but they're not willing to say what they're going to fix. So there's a lot of ramifications about how these rules might apply. So let's talk now briefly about how you should be dealing with this from a governance standpoint. First, the key thing I think here is to educate those that need to know. That's going to be boards and compensation committees, senior leadership, your legal departments, your HR, your finance. They need to understand these rules and how they apply. And that's going to enable you to figure out how to compensate people and then how to report what you have to report to determine whether or not you have taxes. The other thing to remember is that 4960 really isn't a penalty tax. It's really derived from the for-profit tax rules and to put nonprofits on par with for-profits. So unlike the excess benefit transaction rules, which are a penalty tax, but also covered employees is a different group than might be disqualified persons for purposes of the excess benefit transaction rules. So now you've got these dual sets of rules that you have to worry about in the compensation area that are going to overlap upon occasion. And remember, though, that just because you're subject to this new tax does not mean you have an excess benefit transaction. But that doesn't mean you don't have to still figure out, if it's a disqualified person, whether or not there is an excess benefit transaction. So all the things that organizations have put in place to comply with the excess benefit transaction rules and raise the rebuttable presumption of reasonableness still need to be met and complied with as they have been in the past. So at the end of the day, around compensation, you've got more complexity, and your boards and your compensation committees need to understand this. It took us about 10 years to get people to actually accept that there were excess benefit transaction rules they needed to deal with, because most just assumed it didn't apply to them. That's a common in the nonprofit world, is we don't do all that stuff, so we don't have to worry about it. And you know, obviously, if you don't pay anybody anywhere near $1 million, you don't need to worry about it. But those organizations that are larger and do have highly compensated individuals are going to need to worry about this, and they're going to continue to worry about the excess benefit transaction rules as well. So it's just more complexity around the compensation. And with that, Taylor, I will turn it over to you to close us out.
Yeah, thanks so much. The last thing that we want to just flag for folks is because these rules came from a for-profit space, there are some things that we may want to think about from a compensation setting and procedures perspective. We're going to want to make sure that you're gathering all the information you need to really capture a total cost of compensation for your organization. That certainly is going to be a best practice, and you certainly wouldn't want a compensation committee to be surprised when a package that was approved all of a sudden now increases in cost of 20%. Likewise, same on your finance and planning side. The other thing that really I just want to flag briefly, because I know we've gone over, is the fact that there are some contract and compensation terms that have become more commonplace in the for-profit world and executive contracts that are designed to minimize particularly the application of the golden parachute tax rules that you possibly could consider, and it'll be interesting to see if they seep over into the tax-exempt space, but essentially designed to cap the total amount of payments owed to a covered employee at $1 less than the excess, than the 3 times base amount threshold. And by doing so, you can kind of override, or at least maybe give your compensation committee a discretion to override or forfeit certain payments to the extent that they either just barely exceed the 3 times base amount threshold, or to the extent that they go well over that threshold. So food for thought for compensation committees. But as you can all tell from these slides, there's really this balance between this new tax has a lot of both compensation and benefits related items to digest, and as a result, key corporate governance, education, communication, and other items that should be implemented in order to ensure successful compliance with these rules. Thank you all again for attending our conference. We really appreciate it, and please feel free to reach out to any of us with any follow-up questions or comments. Thank you.